Hello everyone, welcome to HNC Level 4, Unit 5, Learning Outcome Part 2. We will be focusing on the difference between financial and management accounting. So far, we have established the financial management and management accounting are two main branches of accounting. We have also stated that external audit relates to financial accounting, whereas internal audit relates to management accounting. So now we will be focusing on the difference between financial and management accounting. Here's a link of a video attached where you can see the difference between financial and management accounting. If you look at the chart, the main purpose for financial accounting is communication of financial position, whereas the main purpose for management accounting is for decision making. The requirements in financial accounting are mandatory, whereas the requirements in management accounting are optional. The primary audience of financial accounting are external parties, which are investors, regulators, tax audit authorities. The primary audience for management accounting are for internal management and decision makers. Regulation and guidelines followed by financial accounting is GAAP, IFRS, and IAS, whereas the management accounting regulations are none. The frequency of producing statements for financial accounting are quarterly, annually, or per period, whereas the frequency of management accounting statements are as needed and ongoing. External review for financial accounting are auditor and regulators. External review for management accounting are none. The focus of financial accounting are past transaction, whereas the focus for management accounting are information to aid decision for the future. The scope of financial accounting is company-wide, whereas the scope for management accounting is narrow per segment, product, etc. as needed. The key point about management accounting. It's meant primarily for internal users, when financial accounting is meant for external users. It's not driven by GAAP, which is generally accepted accounting principle, which are set by the Financial Accounting Standards Board, may be much more detailed than financial accounting reports. This may also include non-financial data. Considering various factors of management accounting and the responsibilities of an accountant. So how does management accounting achieve their objective? So management accounting functions are expected throughout various management accounting system. Management accounting system are a combination of various techniques, tools, and structures for executing management accounting tasks. The management accounting system consists of three main branches: cost accounting system, job costing system, and inventory management system. So cost accounting system consists of process costing, service costing. Job costing system consists of job costing and batch costing. Inventory management system consists of perpetual inventory and periodic inventory system. Moving forward, cost accounting system. Cost accounting system is used to record production operation activities in a manner that the relevant cost of various cost centers, cost units, and cost objects can be accumulated. So in a production company, costs are classified as direct and indirect costs. These are costs that are traceable to a unit of production. Direct costs comprise of direct materials, direct labor, direct expenses. Indirect costs are also called factory overhead, and they are not traceable to the units produced. Cost accounting system can differ accounting to the nature of operations of organization. The various types of cost accounting system, process costing and service costing are discussed in this session. Process costing is applied in a situation where the production is of continuous nature and the cost units can be easily separated. Process costing is applicable to products such as oil refining, paper, food, and drink chemical products. The products costed in a process costing system are all identical and undistinguishable. So to find out average cost per unit, we have to divide the cost of production by the expected or normal output. The focus of process costing is to debit all the cost of production and incidental to various production processes. Techniques such as activity-based costing, weighted average, first in, first out, last in, first out, can be integrated with this process costing. Direct costs are directly attributed to physical products. Conversion cost includes all manufacturing overheads incurred to convert raw materials to finished goods. The advantages of process costing. The main advantages are it enables a periodical determination of cost. It is cheaper to operate. There's a standardization of costing system. It creates room for flexibility. It's a reliable managerial costing system. But the main drawbacks for process costing are it is detailed oriented and detailed analysis are difficult. It is majorly based on historical costs. Estimates may be inaccurate. Average cost is difficult to calculate where multiple products are manufactured. Service/operational costing. Service costing is used by companies operating in service industry or companies wishing to establish the cost of services rendered by other departments. Service costing is related to intangible products. A service company such as electrician, car hire service, hotels, hairdressers, bank, colleges, which cost the services for which revenue would be earned. Also, a company may wish to establish the cost of the service carried out by the service department. For example, the cost of computer department for logistic department may be assigned through service process costing. The advantages and disadvantages of service costing. The main advantages is it provides more accurate cost per unit computation, leading to better price decision, making the performance management. It provides better understanding of the drivers of overhead, resulting to better cost control. It does not relate overhead to production and sales volume. It's applicable to both production and non-production overhead. It's also applicable to both service and product costing, as service overhead must be apportioned to the production departments. The major disadvantages of service costing is it is limited use where overheads are significantly related to volume. All overhead cannot be successfully allocated to specific activities. The choice of activities and the adopted cost drivers may not be appropriate. The benefit may not justify the cost because a large number of data is required. Job costing. Job costing system is used by organization to account for the cost associated with distinct cost objects called job. So each job may be different from the next and consumes different resources. A cost object is anything of interest for which cost is desired. So the 7 steps for job costing. Step 1 is to identify the job to be costed. Step 2 is identifying the direct cost of the job. Step 3 is select the cost allocation basis for indirect cost allocation. Step 4 is match indirect cost to their respective cost allocation basis. Step 5, calculate overhead allocation rate. Step 6 is to allocate overhead cost to the job. Step 7 is compute total job cost by adding all direct and indirect costs together. The advantages and disadvantages of job costing. The main advantages of job costing is it provides thorough information on materials, labor, and overhead. It provides lots of information about the project. Profit or loss from each job can be determined. It enables management to divert resources from a low profitable project to a highly profitable project. It provides databases for costing similar jobs in future. It helps firms to produce estimates and budget. Data can be used for cost plus contracting. The major disadvantages for job costing is it requires considerable effort from the accountant to trace the cost of the project. The basis of cost allocation may not be accurate. It requires a lot of skill and manpower. It does not consider the impact of inflation. Batch costing. A batch costing is a group of products produced together. Thus, the objective of batch costing is to ascertain the cost of the entire batch instead of a specific product. Batch costing is peculiar to firms where continuous production may not be possible because of changes in style, fashion, or technology. The techniques can be adopted by companies manufacturing boots and shoes, nuts and bolts, medicine and drug, etc. In batch costing, the batch is the cost unit. Inventory management system. Inventory are the stock of physical assets that a company trades in. Generally, there are three types of inventories: raw materials, work in progress, and finished goods. An inventory management system is a combination of technology and processes and procedures that oversees the monitoring and maintenance of products stocked by a company. IVMS are integrated with other accounting systems. The objective of a modern inventory management is to manage inventory across multiple warehouses in different locations. If you look at the definition for inventory, in a general sense, it means stock of goods available or held for sale in the ordinary course of business. In business sense, it includes raw materials stored in warehouse, work in progress in production, and finished good available for sale. In an academic sense, it means the stock of goods which have demand and supply in the market and can be easily realized in cash. Inventory management, if you look at the picture, is the purchase department who is stocking in the raw materials and the components to stock out in the production department, where the production department produce the product, send the finished goods stock to the finished product, and then the finished product department stock out to the sales department to be available for customers to purchase the product. There are two types of inventory system. One is perpetual and one is periodic. So perpetual inventory system involves tracking stock level at goods are at received, produced, sold, and returned to the store. Deliver the most up-to-date inventory figures with less dependence on stock takes for accuracy. Periodic inventory system is a way of managing stock that relies entirely on stock taking. Count their stock regularly, say every 3 to 6 months, to verify stock accuracy. Checking whether stock level match up to sales figure. Different kinds of managerial report. Number one is a sales report. The marketing and sales division prepares sales analysis of different products sold in different geographical areas. These are based on the budgeted and actual sales figures, sales variances with reasons. Budget, income and expenditure budget, production budget, cash budget. Cash flow statement, inflows and outflows of cash during the period of operations. Production report. Production report targets achieved by the production department, variation between budgeted production and actual production achieved. Funds flow statement. The accounting and financial division prepared this statement, shows various sources of funds and their applicable areas during any period. Budget and actual profit report. Accounts department of an organization will create this report. Reason for any decrease or increase in an actual profit figure. Machine utilization report. Manufacturing division will prepare this machine utilization report. Time utilized by machines for different kinds of job. Idle machine time as well. Report on financial statement. Income statement and balance sheets give financial information not only to shareholders, but also to the government and other concerned parties. The 7 advantages of inventory management system is it's reducing inaccuracies, enhanced productivity in operation, happy customers, no more manual work, cut cost and increase profit, data security and cost saving. Disadvantages of inventory are higher cost, item cost, ordering cost, holding cost. It's difficult to control, hides production problem, may decrease flexibility. Thank you, everyone.